Hey guys, it's Evan Swanson here of the Swanson Home Loans team, a division of Guild Mortgage. Well, we got an updated inflation report out today, and core inflation continues to come down. However, mortgage rates remain elevated. So it begs the question, what's it going to take for mortgage rates to increase? Let's go ahead and look at a few slides. So normally, as inflation begins to ease, we see mortgage rates improve. Now, we really haven't had significant inflation for decades. So we have to go all the way back to the 1980s. You can see inflation spiked starting in the late 70s. And Paul Volcker, starting in the early 80s, instituted an aggressive monetary policy strategy to help curb inflation. And it worked. Starting in 1981, we saw inflation fall. And what happened to mortgage rates? Well, they began to fall as well. Let's look at the current day situation. As of this morning, we have Consumer Price Index report out for the most current month. Core inflation, which strips out volatile food and energy prices, peaked in September of last year at about 7% year over year inflation. That has fallen to about 4.3%. But if we dive into the numbers, the story is probably actually better than that. You can see here that year over year core inflation increased by 4.3% last month, but that's actually down from plus 4.7% the previous month. So it's trending in the right direction. Here's the thing, if you look at housing, which takes up a majority of the weighting inside the inflation report, the various factors they look at, shelter, rent, and owner equivalent, are all up by over 7% per year. And this appears to be lagging reality. What do I mean by that? Well, data from other providers out there, for example, CoreLogic in this graph, is showing that year over year rents are only increasing by about 3.3%. Yet the government's data is showing rent increasing by over 7%. So once the government's data catches up, we should see inflation numbers continue to fall. But you have to understand, inflation is only one part of the puzzle for the Fed. The Fed has a dual mandate. Number one, they have to keep stable prices, which they define as core inflation around 2% per year. They also are looking to maximize employment, which they generally define as having the unemployment rate around 4%. Let's look at the employment picture. So despite a high interest rate environment, the labor market is extremely resilient. The unemployment report currently shows that it's only about 3.5%, which is much lower than one would expect. You have to remember that coming out of the pandemic, companies had a really hard time attracting and retaining labor. So job openings spiked during the pandemic. At one point, we had over 12 million job openings across the country. Now that number has softened. You can see that currently job opening data shows that there's only about 9 million jobs out there, which is still historically high. Before companies begin to lay off their current workers, we have to see the job openings data come down first. So we're going to keep a close eye on this. This is also trending in the right direction for lower mortgage rates, but still not low enough to make a huge difference. Now, as of last month's employment report, the US economy was still creating about 187,000 new jobs. If you look back over the previous 12 months, on average, the economy created about 257,000 new jobs. But if you just average it over the last 3 months, the economy has created only about 150,000 jobs. So the bottom line is inflation is headed in the right direction. That part of the puzzle is more or less solved. What we're really waiting on is for the employment picture to change. And the Fed is not going to openly, publicly say this, but they'd like to see the unemployment rate rise. In other words, people lose their jobs to create a softer economy to make this inflation figure be more lasting and durable. Once that happens, we will see lower mortgage rates, but it's simply taken longer than we expected. Thanks for watching.